Yes, we can.
Perfect. All right. Well, my name's Alex Bulthuis. I'm a junior analyst. And today I'm going to be presenting to you my equity report on Anthem. So to the right here, we have some metrics which showcases Anthem's current market profile. We're proposing a buy for several different reasons. First, we reviewed the projections of the Congressional Budget Office for Medicare and Medicaid, which both show increased growth, even with conservative estimates, and this is a key revenue segment for Anthem. Relative to other like companies in this industry, Anthem has a strong balance sheet with relatively low leverage. And lastly, we see the current market dip as a favorable opportunity to buy into this industry at a relative discount. So a little bit about the company. Anthem is a member of the Blue Cross Blue Shield, which is an affiliation of 36 independent insurance companies who combine provide health insurance to over 106 million people in the United States. Anthem specifically covers 41 million members in 13 different states with a variety of offerings from group plans, individual and family insurance to Medicare and Medicaid plans. And to the right here, you can see the breakdown of revenue for each of these different segments. Recently, the company has taken steps to improve its cost expenditures by launching a vertical integration measure dubbed IngenioRx. This serves as a pharmacy benefits manager to administer the drug programs offered by Anthem, and this step will help to consolidate operations and to improve its cost structure by moving these services, which are traditionally managed by a third party, in-house. As an insurer, investment of held capital is an important aspect in regards to profitability. With the recent market downturns, it's worth analyzing where Anthem has invested their assets and where this form of income is derived from. As you can see here, the majority of Anthem's investment comes from fixed maturity securities, and they have very little direct equity exposure. It's also worth noting that Anthem operates relatively low debt to equity ratios, as well as just above average for the industry on return on assets. Oh, I'm sorry. Some recent news which pertains to Anthem includes an article recently published in the New York Times regarding potential costs of COVID-19 to U.S. healthcare companies. It discusses how it's still unclear the level of impact the virus may have in net, and it's still unclear the total costs that result from this pandemic, but it came to the conclusion that this may lead to a potential rise in rates moving forward into the future. Another article featured in the Boston Globe discusses the recent lobbying efforts by health insurers for relief in the stimulus package. While this mainly pertains to smaller companies, as they're being more adversely affected by this, they're calling on assistance for the government to help with premium payments. As some workers are laid off, more health insurers could potentially see loss of income from employer-based plans. And earlier in a press release a few months ago, Anthem fully discussed their intentions for IngenioRx, which I touched on earlier as a cost-cutting measure. To the right here, you can see I included President and CEO of Anthem, Gail Bordeaux. She's known as a titan of the healthcare industry throughout several different roles that she served for multiple different companies. She's been named as one of Fortune's most powerful women in business, as well as being named one of the 100 most influential people in healthcare by Modern Healthcare. For our industry overview and competitors, we put Anthem up there against some of its closest competitors of like size within this industry. One of the metrics I want to point out is Anthem's current ratio, which is currently fairly high for this industry. This position would be favored during this recent downturn in the market by lenders due to their ability to meet short-term obligations. Their quick ratio is also favorable relative to some of their competitors, which may also prove to be beneficial during these uncertain times. And finally, we see Anthem's combined ratio near the head of the pack. This shows that they've been able to be effective in the premium pricing and are effective in capitalizing on plans which they have created. And right here we have a graph showing how Anthem has performed over the last 5 years relative to the healthcare industry and the S&P. As you can see, while the industry has slightly underperformed the market, Anthem has shown its ability to grow, not only outperformed its own industry, but the broader market as well. So one of the key drivers, which I thought was really relevant for this company, was the age demographic shifts in America. So as Americans age, we see increase in premium pricing, as well as increased coverage spread at the 60+ age range. Due to Anthem's effective pricing ratios, this increased pricing leads to higher profitability levels per individual customer. This is also relevant when considering Medicaid and Medicare enrollment, due to this being a fairly large component of their overall business structure. As you can see, we have census data right here showing the shift of our aging population over the last couple of years. And with more recent census data from this year's census, hopefully be able to update that and continue to monitor it. So for the growth analysis, as you can see, the exponential, speaking of Medicare and Medicaid enrollment, I went ahead and pulled up data from the Congressional Budget Office, as I mentioned earlier, to project where they see spending in these segments over the next 5 years. As you can see, the exponential rate of increase is nearly 10% a year in total projected costs, showing a growing market as our population ages. This brings me to a valuation model. So for our earnings model, we included a few unordinary adjustments. We inverted our revenue for a compounded annual growth rate to negative 6.6% for 2020, as we expect the revenue to decrease due to lost premiums in local groups and total national segments. Our revenue growth rate for the remaining years is approximately 3.6%. And while these figures are lower than our recent historical average, we're not as optimistic that future growth will be able to maintain the rapid pace that Anthem's previously managed due to potential downturns in the economic cycle. We've also not fully priced in the potential cost savings of bringing a pharmacy benefits major in-house, but we believe these will add decreased costs and diversify Anthem's growth moving forward. We ran a DCF, as this model seemed to be the most relevant for the industry, where cash outlays are paramount. Based on this model, we came up with a fair value estimate of $246.70 per share at a base rate estimate. And while the company is now trading slightly above this price due to the delay of the presentation, we still believe this is a very conservative estimate on pricing. An increased growth due to future pandemic fear could push this fair value to current pricing or above. And this brings me to my investment thesis. So due to the monopolistic type regional control over the markets in which they operate, the aging demographic shifts of the American population and the profit structure of these shifts, Anthem's low leverage position beneficial for them relative to their competitors during these uncertain times, the steps they've taken towards vertical integration to assist with cost structures, and the current discount pricing, which is reflected by the graph to the left here, which shows the overall drop in price for the industry. We're recommending buying 20 shares of Anthem, which would represent a 1.94 weight in the portfolio and bring our weighting in the sector to the desired level for the fund. Thank you. Any questions?